I've been investing in real estate for almost 6 years now. I bought and sold 21 properties. I have never qualified for a conventional mortgage. This is the first time I ever bought a house with the intention of it being my primary residence. And as you can see, this is my dream here. If you notice the big board on the back here, that was the bike jump that the local kids had set up out to the backyard. No conventional lender is going to touch this house. No cooking facilities, no bathroom facilities, no sleeping facilities. It's not considered habitable, and it's no longer financeable.
In today's video, Kyle Ford breaks down for us building his dream home, as well as discusses taking over a project that a previous flipper failed on. He also dives deep into financing explanations and mortgage questions that I know a lot of the audience has, and we even discuss breaking through the 5 mortgage barrier.
All right, Kyle, what are we looking at?
My dream home.
You sure about that?
Positive.
Right, let's do a tour.
Awesome, come on in, guys. So as you can see, a little dark and dreary here. If you notice the big board on the back here, that was the bike jump that the local kids had set up out to the backyard. This was a property that I picked up a couple months ago. Obviously, we haven't had a chance to start. We've been in the zoning approval. The previous owner bought this property to convert it into his dream home. Bought it with conventional financing because the home was livable at that time. He then went through gutting it start to finish, putting in the beam, everything along those lines, and was having issues with this property is zoned heritage and GRCA, Grand River Conservation Authority. So he was having troubles with that. Couldn't build his dream home and ended up finding another property. So a realtor brought this deal to me as well. We were able to pick it up at $450, which might seem crazy for what you're seeing right now, but this is almost an acre lot. This is located in a very, very desirable part of Kitchener. We have no neighbors on our left side here, one neighbor on the right, and a great school across the road with a giant field. So a true piece of privacy in the heart of the Tri-Cities here. So for this property, this is actually going to be, this is the first time I ever bought a house with the intention of it being my primary residence. Every other property that I bought was a rental property that I decided to move into, anything like that. So this was the first house that I decided to buy to live in. And as you can see, this is my dream here. When we do this house, we're going to just be doing kitchen across over there, dining set in the corner, and living area here. Like all my properties, I don't want to have to pay for it every month. So in the basement, we're going to be putting an Airbnb. This property is located about 5 minutes from Conestoga College. So tons of people doing short-term programs, coming here until they find a more permanent place. Our other Airbnb in Kitchener does extremely well, and it's nowhere close to this desirable of a location.
And so how does financing work? Obviously no longer conventional.
No. TD Bank said no. No conventional lender is going to touch this house. The rule that you need when you're buying a property is you need to be able to have a shower the next morning, use the toilet, and cook yourself some food. So if there's no cooking facilities, no bathroom facilities, no sleeping facilities, it's not considered habitable, and it's no longer financeable. With this property, we bought it for $450. We had to put $25,000 down, which is a substantial deposit. That was the deposit we had to put down. Because they knew it wasn't financeable, they wanted a big deposit to show we had cash. The $25,000 came off an unsecured line of credit, and then I got a $425,000 private loan for 6 months, no payments, to purchase the house.
What is the overall plan? So you kind of walked us around the inside here. You're also planning an addition?
Yeah. When we bought this house, this was the outdoor swimming pool that came with it. This was full of water. They had excavated it to put the addition in, but didn't go forward with that. So not only was this full of water, that led to about 3 feet of water into the basement. We actually couldn't even go in the basement when we bought the house. It's dry now, we can go in. But this is where the addition on the property is going to go. This house is a 2-bedroom house up top. So what we're going to be doing is extending this over to the side, putting a master suite above the 2-car garage, and also being able to add a main floor powder room, which we feel is very important. So the intention for us on this house is we are going to buy this house as myself and Chelsea are going to buy this house as our primary residence. We're going to live in the main floor unit and Airbnb out the basement, and so and then eventually sell it and move on to our next even more dream home.
Awesome. Do you know what the numbers look like on this, like ballparks?
Ballpark, we're going to be we purchase at $450 with interest, building costs. We're going to be into it for about $250,000, and we're going to the ARV on the project. We're projecting at about $800,000. So we're hoping to see about $100,000 equity build on this, and we're going to be basically owning an $800,000 house with 60 grand of our own cash by the time the refi is done. Another kind of cool fact about this, I've been investing in real estate for almost 6 years now. I bought and sold 21 properties, or I own several properties, but in total bought and sold 21. I have never qualified for a conventional mortgage. When I started off, I had to use, I was self-employed, I had to use partners. By the time I actually got my income up, I changed careers. And then beyond that, when I got my income up to the second time, I owned too many properties with JV partners that I didn't qualify. This is the very first property that when it's done, I actually qualify for conventional A-rate financing, which shocks a lot of people to know that I bought and sold that many properties without ever actually qualifying.
I thought it'd be great if we just sat down with Kyle and chatted a little bit about his backstory. After touring the 10-plex, there's a few details about your backstory that came out that I thought, you know what, we need to really just like dive into it. So one thing I found fascinating is you were saying this is going to be like your first conventional mortgage.
Yep.
Let's talk through that.
Yeah, so when I started, the very first property I ever bought was a pre-construction condo. So I bought it under the terms where it was $2,500 down, $900 a month. I had to pay that for 15 months. So I was essentially making a mortgage payment while I was living at home. But they didn't do any background. They didn't do any mortgage pre-qualification. Right. I cut them a check for $2,500, 15 post-dated checks for $900, and off I went. The second deal I ever did when I bought a property was my brother was about to sell his single-family home to buy another one in Woodstock. It was a low price point, $160,000.
Okay. So
I made a suggestion to him, and I didn't know what I was doing at the time, but I was like, what if you refied to 80%, and then I gave you $15,000, which is the $30,000 you have left in that deal, and then we're partners on that deal. So that was the second real estate deal I did. Still never qualified for a mortgage. Going forward from there, that's when I got educated on what real estate investing actually is. Yeah. How to identify your own investor profile, what deals you should and shouldn't do. So I discovered that buy and hold was definitely a strategy that I should focus on. Went to a bank, wasn't approved. Went to mortgage brokers, wasn't approved. I was 24 and self-employed at the time. Learned what that was all about. But I didn't let that stop me. So I did whatever a self-respecting 24-year-old do. I asked my mom to co-sign. I put together a business model, and she did that. So starting with my mom, I then went to a couple other family members and got them to co-sign on some deals for me. My sister, my brother, my dad eventually, they all just started co-signing on deals for me. So by the time I actually got my income to the point where I qualified for deals, I was on title of more than 5 properties that even though I had the income to support it, I no longer qualified for the deal. So it was actually, some people, might perceive that as a challenge. To me, that was the best thing that ever happened to me in real estate. So many people are blinded by a 3% interest rate and 20% down, and they think that's the only way to make money in real estate. But if you learn how to do it without qualifying, you're in a different mindset that the sky is the limit in terms of financing.
What have friends and family said about, your aggressive real estate investing strategy? I know for myself personally, a lot of people thought I was crazy at first getting into real estate. You're a young guy, taking on lots of debt and leverage. Did everyone understand what you were doing, or was there any pushback?
Well, if I can backtrack a little bit on that, Matt. When I said I was self-employed, I was working as a financial advisor. So I was working in the conventional side of financing. I was working with RRSPs, TFSAs, mutual funds, conventional mortgages. So I really understood that side of it, and I was able, and basically the way I positioned it as is, when I finally got out of that business, I was able to say to them, the reason why is the risk of not doing anything, the risk of doing the conventional way of doing things, saving for retirement, paying off your mortgage. To me, the risk of what that actually looks like in retirement is a lot greater than taking on some debt and living a lifestyle you want at a much younger age. So one thing I say all the time is that everybody says you're crazy. until you do it, and then you got lucky.
Yeah.
And then you're lucky for a really long time, and they still don't want anything to do with it. And there's about, it seemed to me around the 10 property mark, where all of a sudden the crazy and the lucky was gone, and people wanted to give me money.
Yeah.
People wanted to sign. So in those first couple deals, there was definitely, you know, I remember the first deal I did with my dad and my stepmom. She scrutinized the heck out of everything, but I was buying on cash flow. The properties produce a solid income.
Yeah.
So it wasn't, hey, let's buy this because it's going to go up in value, which so many people do.
Yeah.
It was buying based on the income. So despite the many questions and concerns that I had, when it came down to it, I had a solid business model, and the numbers make sense.
Yeah, you really need to trust in your numbers, you know. And one thing you hit upon there is you kind of came to your friends and family with a business proposal, right? So you laid everything out.
Yeah.
Do you mind laying out for the audience just some tips or tricks on when you're approaching that first family member or that first friend as a prospective investor?
Yeah.
What would you recommend they do?
Exactly that, Matt. Approaching them as an investor.
Yes.
You're not coming with hat in hand, please mom, will you sign for me? You're coming to say, hey mom, I have an opportunity here that I think could be a win-win for us. I think that based on my numbers, based on my projections, this could help your retirement and also helps me get my foot in the door. So it was coming from a position of strength, saying this isn't just about me. This is how I can help you. This is how this can benefit you in your retirement. So so many people, you know, even in my mortgage business, I see so many people, well, I don't want to ask my parents to co-sign for my rental property. Well, don't ask them to co-sign, ask them to invest in it. Give them 20% of the profit.
Yeah.
If you can get, if the difference between, if the deal needs conventional financing for the numbers to work, and you can't do it on your own, give up a percentage of the profit to somebody to get a part of the deal to build your portfolio up until you're at a point where you can either go commercial and qualify or qualify for financing on your own, depending on the scenario.
Yeah, those are great tips, and it's just really important that you do approach it as a sophisticated investor rather than the hat in hand or asking for a favor. You guys may not realize it, but Kyle's actually a mortgage broker as well as a real estate investor. So what's something that a real estate investor or a novice investor, aspiring investor could do to make it more likely that their mortgage broker is going to say yes to them? Maybe there's some tips you can share?
Get organized. Submit a complete file up front. It's shocking to me, not just the mortgage brokers who don't understand investment real estate, but the underwriters that don't understand investment real estate. So when you need to get organized on your file, you need to get organized on your numbers, and I often ask for a copy of your projected numbers to support your file. The more professionalism that I can show in your application, the more likely it is that we're going to get an approval. The other part of that is sometimes we get an underwriter who might be a great person and a great underwriter on the single family side of things, but they get your file on the back end of the big five banks, and they've never owned a piece of investment real estate in their life. They don't get what your numbers are. So the more organized we can show them, the better.
Seeing how Kyle is a mortgage broker, we thought since we got him cornered, let's talk about this rumor that everyone always talks about, the 5 property limit. So I don't know how often, but every single networking event I'm at, people come up to me and they're like, how do you have more than 5 properties? It's impossible.
It's absolutely not true that you can only get 5 mortgages. And when we talk about the 5 mortgages, let's talk about the A side of lending.
Yeah.
These are no lender fees, no broker fees. These are mortgage rates in the low 3s, high 2s potential. The first thing I want to talk about is the very first mortgage you get. So many people, the number one question they ask is, what's the rate?
Yes.
Why do you think that is?
I think a lot of us are just trained to think that that's the most important thing about a mortgage. Like, it's really strange, but I agree. When I first started investing, we were so proud that we had this like prime minus 0.85%, and like we were bragging to everyone about it. But with hindsight, I think where you're going is what we learned.
Yeah, what's more important is number of mortgages, not interest rate.
Yeah.
And we see that a lot. So I'm more concerned about working with lenders that are willing to offer more mortgages than less on the interest rate. So it also goes back to planning. We want to be going to certain lenders at certain times. There's certain lenders that don't mind adding your fifth or sixth or seventh mortgage, but they want to know where your first 5 are. Maybe they want all of the first 5 to have fixed rates, not variable rates, so they could stabilize. They know your income is stabilized, or your expenses are stabilized. So if we go to somebody who maybe has 3 properties, and now they're saying, we can't get any more financing, we're done. My broker said no. Well, the first thing I'd ask is, does your broker have more than 3 properties?
Good question.
If they don't have more than 3 properties, they probably just don't know how to get over that. The second thing is did you talk to that broker about, what if I took a step back with some of my properties? And what I mean by that is, let's say you had that great prime minus 0.85. What if that meant you had to break that mortgage, pay a 3-month penalty, and take a higher interest rate? Are you, as the investor, willing to do that to get the 4th mortgage? Sometimes brokers are scared to present something like that to the investor because they think the investor is going to get upset. Because maybe they're not that established of an investor themselves. I like to tell my clients, but there's almost never a time that I can't get you a mortgage. You just might not like the interest rate.
That's a great point.
So what we're doing a lot on our files now is, if it's turnkey property, we're going straight for conventional financing. We're starting with A lenders. Sometimes that means we have to go with a B lender. A B lender is not 8%. We have B lenders funding deals at 4% with a 1% fee right now. That's not an outrageous number.
Very reasonable.
Very reasonable. They're happy to give you your 7th, 8th, and 9th mortgage. Those lenders might only give you 4 themselves, but there's about 10 different B lenders. So you start extrapolating that. The next very important thing is, you got to be buying cash flow properties. If we have 10 condos in downtown Toronto that are under rented, you're not getting more mortgages. If you're buying multifamily properties in London, Windsor, Kitchener, Niagara region, an area that produces a good cash flow, lenders have worksheets that a good broker can use to wash out your other properties and allow you to qualify for additional financing. So I mentioned A financing. B financing is fantastic. What we're doing a lot of now with my investor clients, mostly it's not because they can't get a financing out of the gate. They just want to move faster than A financing allows.
Good point.
So what that means is, on A financing, let's say there's a deal where somebody wants to do a duplex conversion. I could qualify them for A financing, but they don't have the money for 60 days until their flip closes. Okay? So what I do in scenarios like that is, I might secure a second to that flip. So they have the down payment and a private to close the duplex conversion. So by the time everything's done in 60 days, we're not starting the duplex conversion. It's a fully renovated, ready to go duplex. Now we're taking that duplex to the A lender out of the gate. Is there fees? Is there higher rate? Absolutely. But if you look at if you can be doing deals in your waiting period for a closing, what is that worth to your net worth, your total ROI?
I think the key is, far too often investors get caught up in one detail rather than the full picture, right? And that's where Kyle's really coming from. We just need to look at that lending fee, that origination fee, whatever it's called. That's just the cost of doing business. And if we factor that in, do the numbers still work for us? The answer is yes. Why wouldn't you proceed?
100%.
Those were some fire tips.
It was great going over everything with you guys today. I'm excited to chat more with anyone who's interested. The links are below, and looking forward to doing a lot more content in the future.
Thanks again to Kyle for taking the time to really break down for us the details behind mortgages, loans, and breaking through the 5 mortgage barrier. In addition, if you guys are currently looking to grow your portfolio, check out Manage Your Property Smarter. It's a Facebook group that's free that we've put together for property managers, landlords, and real estate investors, because at the end of the day, you got into real estate investing to be an investor, not a landlord.